Jenny had brought us the view that potentially we could see a currency pact, one that had already been conceived of between China and the US. Does any of this partial deal that's being discussed have real ramifications for the US and the Chinese economy?
It could be if you get indeed a deal that's, let's say, the gateway to ultimately this grand bargain that they're after, right? And then what the economy would particularly be responding to would be that this interim deal would lead to real de-escalation of the tariffs next year. Now that's important, right? Because we're going not only into election season, but we are dealing with a real slowdown in the economy that's now visible. So yes, it could be impactful if this interim deal is, say, constructive and credible enough that it could lead to de-escalation.
You know, one thing that's striking to me is that this is happening, obviously, at the same time as the controversy with the NBA and all types of other things. And I'm just trying to think politically for a second, because obviously the easy sort of line of reasoning is that, yeah, Trump wants a deal. It could help the economy. It could help maybe give some business confidence. Maybe it could help lift the stock market to new highs. Should investors perhaps be worried about the opposite, that maybe he doesn't want a deal and he wants to run with this big oppositional force out there, this tension, and that maybe we've sort of, investors have gotten his politics wrong?
Well, if you look at his tweet today, where he basically talked about, no, so China wants a deal, but do I?
Right.
So I thought that was very telling in the sense of still keeping very much of a stronghold here by, I'm just going to continue with my vision about this China trade deal. It has to be a big deal. It has to be structural, constructive, that I can really carry through the 2020 election. And markets did respond to that tweet particularly, because it does show, like, if any sort of minimal deal that we get would be essentially a weak deal, so to speak, it would have to be more constructive for that matter. So you can actually look at the market very simplistically right now. The S&P is within the range of where August was trading, which where all the stress are happening, and the 10-year is not too far away from the lows either. So that does tell me there's a lot of caution there about what's happening next.
I wonder what sort of unravels that caution, though, Ben, because, I mean, when you look at the markets right now, there's clearly a short-term knee-jerk reaction to anything positive on the trade front. And I'm wondering, does that actually translate into sort of a long-term boost to financial markets or to the economy itself?
I think, again, if it leads to the tariff de-escalation and it becomes clear that that was a means to get this deal together, not just a confidence boost, but ultimately that those sectors that have been impacted already by these tariffs, and it is showing up in manufacturing, yes, there would be a boost. You know, you could simplistically say, what's the best rate cut to have? That's a tariff cut, right? I mean, it would be that way. And obviously, if China were to comply with the other way, saying we're going to lower our barriers, then there's going to be a fair amount of trade volume pickup. So one way we can compare this is to the 2009 rebound. That was a huge trade resurgence globally. And of course, that's the financial crisis effect. In this case, you could have something similar, a pretty depressed trade volume out there. If you get any kind of like constructive deal, trade volume could pick up, and it could affect more countries than just US and China.
How would it affect the bond market in the respect that at the moment we are seeing slight sell-offs on days like today, yields coming higher in the US, but are we inevitably capped by the fact that we've got such low borrowing costs in Europe, and that doesn't seem to be changing anytime soon? Right, there's the structural issues there. I thought it was very notable how during this entire trade war, and particularly escalation, that the view by bond markets has been that the long-term neutral rate has fallen so much, almost a percentage point. It does say that the economy is going to be structurally impacted by the change of trade, and as a result, you know, interest rates will not see a meaningful normalization in the future. That said, it does look like that we're at the trough again, like we were in 2012 and 2016, and now this year. And so, are we staying in this major range? Probably the 1.5% to 3% range.